Okay, hello everyone. This is Capitaland Integrated Commercial Trust first quarter 2024 business update dated 19 April 2024. This is a follow-up from the annual report discussion we had in the last video, right, which was effective 31st December 2023, right? So this report is based on the latest 3 months, right? So what has happened in the last 3 months, right? We see that net property income is up 6.3% year on year, right? These four things I won't discuss because I don't think they are make big changes or they are very important, right? So this is the first good news, right? The second good news I think is the year-to-date rental revision for both retail and office side are very impressive, right? Sorry about this. Okay, so retail portfolio is up 7.2%, whereas office portfolio is up 14.1%, right? So this one is really very high. I'm not sure how much was actually revised, but whatever was revised as at a very good rate. Retail portfolio, we expected it to not be as impressive as last year, which was 8+%, but 7.2% is still very good, in my opinion. Right, they have comments, AEIs at IMM Building and Galileo Frankfurt, which we have discussed before. But this is the good part of the report again. And other good news, they have secured lease agreement with the European Central Bank for about 93% of the net lettable area at Galileo Frankfurt. Right, that means Galileo Frankfurt is more or less occupied already. And European Central Bank is the central bank. So I expect that they have no issues collecting rent from the ECB. Right, so they won't have any like default problems like, for example, Keppel DC REIT has with the Guangdong DC centers, right? They have also issued new units at a price of $1.93, right? I believe that these funds that they raise is most likely going to be used to pay down debt, as they have discussed in the last annual report. They don't seem to have any intentions to buy new assets, as far as I understand it, right? So IMM undergoing AEI is already 75% occupied, right? If we include the leases under advanced negotiations, all right. Galileo at Frankfurt, even though it's undergoing asset enhancements, right, it's already 93% occupied. They will expect to hand over to the European Central Bank from second half 2025, right? So that's where you start contributing to revenue. Right, so why did MPI improve so much? You can see gross revenue went up 2.6%, but because of lower operating expenses, which is really, I think, a good thing, right? Because most REITs are struggling with higher operating expenses, right? Then that is the reason why the MPI has gone up by 6.3%, which is quite impressive. Right, we look at the debt, right? As of 31st December 2023, they had 16% to refinance in 2024, right? But you can see that they've already dealt with 3%. Where did the 3% go to? Right, 2027 1%, 2028 1%, and 2030 1%, right? Because these red color numbers are as of 31st December 2023, right? You can see that it's gone up 1% each. Right, so capital management, aggregate gearing went up 0.01%, sorry, 0.1%, right? So it's quite little. Borrowings of fixed interest rates gone down 2%, right? Interest coverage ratio is 3.1%, and average cost of debt has gone up by 0.1% as well at 3.5%, right? But this is something we expect, all right? But we'll have to monitor moving forward, right? So generally, occupancy on the retail integrated development side are up, right? Office is slightly down, right? Although I'm not very concerned about it, right? Because overall it's still very high, right? Right, so we look at the retention rate for both retail and office, right? They are both very high at 88 and 84%. So I think this is a good thing. It means that generally speaking, the tenants are paying manageable rents, right? Otherwise, they won't be able to stay with CICT, right? So we want to compare the rental revision compared to last year, right? So if we look at this latest 3 months from January to March 2024, right, we realize that it's around 7.1 and 7.2%, right? And if we compare it to last year, which was 8.3 and 8.8%, and overall 8.5%, okay, so clearly there's a dip, right? But if you look at the sales increase, it's not at this 8% rate, so you cannot expect this high rate to be sustained. All right, 7+% I think is quite a good rental revision to get. Right, then we look at also tenant sales per square feet, which last year was 1 point something percent. All right, so it's actually better this year at 2.1%. Right, so that's a good thing. Right, so the reason is because of the 30-day visa waiver between Singapore and China. So the tourism, the Chinese tourists that came in helped out. All right, and domestic market has been quite strong. Right, and despite job concerns and wage growth moderation, right, CICT believes sales should are expected to stay robust, right, because of government aid and also easing inflation. All right, although big ticket purchases may be affected, right, but this is something we discussed in the last annual report. Right, we look at shopper traffic, right, you can see that both are not too bad, up 3% and 4.2%. But for downtown malls, right, despite the higher than average increase in shopper traffic, right, you can see that it hasn't really translated to sales. Okay, so downtown mall not so positive, not as positive as the suburban malls, right? Right, so yeah, we'll look at again improving tourism numbers to help downtown mall traffic. Right, so we look at the top 5 trade categories. Right, you can see how the tenant sales have changed year on year. Right, you can see that a lot of changes from the annual report. Right, jewelry and watches was one of the last two. Right, that means they declined with pretty high percentage in 2023. Right, so it's nice to see a rebound that they have improved to 4.5% increase in sales. Right, so this could be a change in consumer spending. That means to say maybe they are more confident currently than before, or it could be also due to the boost in the tourism numbers. Right, that one is I don't have the visibility for that information. Alright, but you can see that the top improvements are books, stationery and gifts, as well as beauty and health, whereas the things that slide to the bottom two are hobbies and sports. Right, as to the reasons why this has happened, I'm not very sure. Okay, so shoes and bags has become negative. Right, initially was the top 2 category in 2023, right? So could be just a drop off due to being on a high base. Right, so optimizing tenant retail. Alright, so I think CICT is generally a good mall manager, right? So I don't really have too much to say about that. Right, so you can see the Singapore occupancy has gone down. Right, Germany has gone down. Right, Australia has more or less increased a little bit. Alright, and Singapore is largely due to low occupancy at Capital Green. Right, so I think we just quickly look at the outlook. Right, you can see in terms of GDP, right, the forecast the first 3 months of this year was 1 to 3%, but we more or less estimate that it should be 2.7%, which is a good thing. Right, it's on the higher end of the estimate, but inflation is 3.6% year on year, which is not good. Right, because this is higher than the estimated 3.5% upper end of core inflation. Right, so one piece of good news, but one not good piece of news. Right, Germany and Australia are not super bothered, right, because not a very big part of the portfolio. All right, so limited retail supply, all right, coming up, that should help rental revisions for the retail side. Okay, we quickly look at the last part on tourism. Right, so first quarter they seem to have quite a big boost in tourism, 4.4%. Right, throughout the year it should be 15 to 16 million visitors, so even for the upper estimate is about 4 million a quarter. Right, which means that we may have the most tourists hit our shores already lah. So Q1 could have been a peak for international visitors to Singapore. Alright, so this is office supply. Right, so in the central area, right, this seems to be quite a big supply coming up. Right, not sure what this impact will have on the office rental revisions, but so far, if I based off the annual report, CICT seems confident that it will be okay. That means they'll do okay in the office rental revision side. Right, so this is the record office rental rate in 2008, right, which was just before the global financial crisis, right, at $18.80. Right, you can see currently it's $11.95, which is more or less fluctuating around this rough maybe $8 to $12 range. Right, so it remains to be seen if they can go back to this $18.8 dollars. Right, so the rest I think I won't say too much about. Right, so to me, CICT is a safe harbor amidst stormy seas, right? Given the interest rates, uh, doesn't look like it's going to come down in the near future. I think they have made the right decision to try to pile down their debts, all right? And also, I think that this REIT will not do exceptionally well because they are very conservative. But on the other hand, I think they are one of the REITs that are very stable in Singapore lah. If REITs were to collapse, I would expect that CICT will be one of the last REITs to collapse lah. And I expect that their dividends should be relatively sustainable and possibly improving in the near future. Alright, so again, none of what I've said is financial advice. Please do your own due diligence. Okay, with that, thank you for your time.